Welcome to this video. In this video, I'm going to be doing a Fastly stock analysis. Now, if you don't know what Fastly does, it is a global edge compute company. But what does Fastly actually do? Well, for example, they have clients like the New York Times, and here they use their content delivery network. But what does that mean? Say, for example, this article with the red line below it is wrong. They can then within their system say with one prompt, change everyone, and it works like these boxes. So they change one and it changes all the others. So there might be ads running the same article, but then of course the article right here would change in every single one with one prompt, and it takes 1 second instead of several hours as it would if they don't use this content delivery network. Secondly, they have security, and their security is quite nice, and of course we're going to need more and more security in the future because of AI and quantum computing, which is going to make hacking a lot more difficult, or easy I should say, but it's going to make the security a lot more difficult. But here Fastly has something quite interesting. They have a DDoS security, but this doesn't work like they normally does. They have a reverse DDoSing where they use their own bots against the DDoSing. So instead of the DDoSing attacking a single port, so to speak, they will then have several bots who can take the hit, so it's more spread out. Like it's quite interesting to see, which is also why their security division is growing about 32% revenue year over year. Lastly, we have Compute Edge. Now, what is Compute Edge? This is because they have a global content network, and this is because they have so many servers all over the world, meaning that the compute time is much lower. This is a lot like 7-Elevens, for example. Now, imagine you're in Stockholm and you need to change something, then you have a server right there and it changes much faster compared to if it was a server in Los Angeles. And it is quite simple. So this is a great opportunity because, of course, it is much more decentralized. Now, some notable customers to have actually this is quite useful for example, take Reddit. So there's a huge spike in a rival post, let's say in Amsterdam for Reddit, then the Amsterdam server will take all the hit instead of maybe a server in California, meaning none of the other servers are impacted and the Reddit users can then have a much better experience without lag. They also have companies like Shutterstock. Say you are walking in on the street with your phone looking at an article and the image is in 4K. Then you walk into a tunnel and your network connection gets much poorer. Then it will automatically make the image less quality so you can still use the site and scroll on the article. And for example, like a flight company like JetBlue, they can then remove scalpers from their websites because they can automatically trace it and remove them from buying any of their products. So this is a quite interesting business model and one of the reasons I like Fastly quite a lot. Now, if we get back into the stock, it is quite obvious that it absolutely exploded here yesterday. Now we can see it raised all the way from 9.20 all the way up to its peak at 19.15. Now the reason for this is quite obvious right here. Their earnings surprise was up by 116.23%. That is absolutely crazy, as well as a revenue spike at 6.97. Now, something you should know before thinking this is an absolute crazy increase, if you take a broader look at the stock, we can see it has been trading at a quite higher price for some time back, and it did that for quite a while, meaning a lot of investors are sitting in this stock with a loss, of course, unless they bought up a ton down here. But we know for a fact that many people didn't, and the reason we know this is the volume. Just look at this. The candles down here are very small, meaning the average volume isn't that great. We can also see that over here as the average volume is 9.93 million over the last 30 days, but the volume recently has been 17.41 million, meaning a lot more people are getting into the stock right now. With that being said, the stock is also quite volatile at the moment. Now, even though it has a relatively low beta at 0.83, meaning it is 17% less volatile than the average index, we can see that it is up here in the upper RSI. Now, if I make each candle 30 minutes, it gets a bit easier to demonstrate. So, the RSI is which way momentum a stock has. So if it's above 70 up here, it's what's being called overbought. That's because we have a ton of buyers in the market. So we have it being overbought almost up at 100, and 100 is peak. And we're trading all the way from 94 to 97 in the RSI, meaning it was quite overbought. Now, this doesn't mean the stock won't rise even more, but this means the stock price is rising rapidly, and chances are it might even fall just a bit, but if it falls, it would then fall oftentimes a bit faster. Always be a bit more careful when a stock is trading up here in the upper RSI, or the overbought, I should say. This down here is just the upper RSI, that is between 70 and 50. Now, when a stock is here, it is quite normal that the stock price is just rising normally. If it's below 50 but above 30, we're in the lower RSI, like right here, and the stock price is falling like normal, nothing crazy. Now, if the stock price is falling rapidly, like over here, we are on the lower RSI. Again, this doesn't mean the stock price can't fall lower, but this means it's falling rapidly, and most often not, again, it is more volatile down here. Always be careful when the stock price is trading at high multiples in the RSI. But then again, I said relatively low beta for a company of this size, as they only have a market cap of 2.6 billion. Now, if we go into the revenue, we can see something that is quite interesting. Statements. If we look at the year by year, in their total revenue, it increased by 38.6%, then by 45%, 1.8, and so on and so forth. So the revenue grows quite consistently and by quite high margins. However, the operating income still is negative, which is also one of the reasons why they have debt. If we go into the overview, it is obvious they have a relatively high amount of debt compared to their market cap. So they have a market cap of 2.6 billion and they have debt of 430 million. But they, however, they do have cash for 361 million, so it's almost the same, which is lovely to see. Now they have a relatively high amount of free float shares for such a small company, which is something we like to see. Now, free float shares are the shares in the actual market that we can buy, and closed held shares, this is often from investors like the CEO or someone who was in on the IPO, and this is often huge banks. Now, if we look at the valuation ratios, we have no PE as they're not profitable yet, but we can look at their price to sales. It has been lower. Currently, it is at 4.40, and has previously been at 2.40. But of course, given the recent rise, it is a bit higher. If we look at the seasonal just all the way back, it isn't the most incredible company. We have seen it fall quite a lot by several years. So 2022, 21, and 24 as well. 2019 wasn't impressive either. Then we also have years like 2020 where it was up by 300%, a year like this year where it's up by 72% already, or a year like 2023 where it's up by 120%. But we have some great years and some bad years. But however, because of course it fell so much in 2021 and 2022, in 2023 you wouldn't have profited if you just bought in 2021. Now, if you look at the technicals for this stock, on the days it is a buy, for the week it's a buy, and for the month it is still a buy. And we can actually see quite a lot over here in the moving averages are a buy. We only have one sell, which is on the exponential moving average 50. If we look at the analyst rating on this, they're quite poor at the moment, but then again, it just had this huge increase. However, we have 3 strong buy, 7 hold, and 1 sell. Now, given this recent increase in earnings, a lot of these investors are going to have to reiterate their analyses, unless, of course, think it's still the exact same company. So chances are we're going to see some other price targets recently. What do I think it's going to be within a year? I think about where we're sitting currently isn't unlikely. I think it's not overvaluated, but I do think a lot of people are going to get out because it had this 100% increase overnight. So I think it's going to fall a bit back down and then it's going to continue slowly upwards again in the future. But I do think we're going to see some better price targets from a lot of analysts. If we look at EPS, we can actually see they're actually estimating it to be profitable in 2026, which is something that I can't wait to see, at least in their EPS. If we look at their revenue, we can also see it's slowly but surely growing more and more, and that is something we want to see. And I can't wait to see them being actually profitable, which wouldn't surprise me that happen quite soon. Now, I have to say I do like Fastly quite a lot. I do have a small portion in my portfolio, and the reason I bought them is because, of course, maybe I'm wrong and it's gonna increase. So I just bought a smidge. It is only about 1.1% of my own personal portfolio that is in Fastly. And I also do this because then, of course, I am more invested in just looking at it normally. Now, if you did like this video, please don't forget to leave a like and subscribe. And of course, remember, this isn't financial advice. This is purely for entertainment and educational purposes. But if you want to see more videos like this, please leave them in the comment section below. The company show me and lies. Thanks for watching.